If you're a beginner, how many stocks should you have in your portfolio? That's what you'll discover in this 9-minute video. First, I'll show you the sweet spot, the number of stocks that actually reduces your risk without killing your returns. Second, we're going to break down what diversification really means and why most people get it wrong. Then, we'll go over the signals that tell you it's time to adjust your portfolio, so you're always positioned for the best results. And I'll teach you how to build an Excel spreadsheet for this. And since this video is part of our Investing for Beginners series, make sure to subscribe so you don't miss the next steps in our journey. Well, let's start with the sweet spot, why diversification matters and how modern portfolio theory explains it. And to give you the answer once and for all, I'll show you a graph and the number, and then I'll explain the theory, the diversification, and everything else. This chart shows one of the most important lessons from modern portfolio theory. The benefits of diversification drop off quickly after a certain point. You've probably seen several finance YouTubers saying not to put all your eggs in one basket and to buy several different assets to make up your portfolio. I'm here to tell you that it works, but even diversification has a limit. On the x-axis, you have the number of stocks in your portfolio. On the y-axis, the standard deviation of returns, which is just a fancy way of measuring risk or volatility. The higher the number, the more your portfolio's returns swing up and down. When you hold just one or two stocks, your total portfolio risk is extremely high, over 30% in this example, because a single company's bad news can destroy your returns. But as you add more uncorrelated stocks, your total risk falls sharply. By the time you reach about 20 to 30 stocks, you've eliminated most of what's called unsystematic risk, the company-specific risk that diversification can remove. From that point on, the dotted line flattens. This means almost all the remaining risk is market risk, the kind that diversification alone can't get rid of because it comes from economic cycles, interest rates, and broad market moves. Whether you hold 30 stocks or 100, your volatility won't drop much further. That shaded zone between roughly 20 and 30 stocks is the sweet spot for diversification, enough to protect you from company-specific disasters, but not so many that you end up just tracking the market with no extra return. And here's where the discussion from intrinsic investing adds another layer. If your goal is simply to capture market returns, the safest approach is to own the whole index. You won't beat the market, but you also won't lag it. You'll get exactly what the market delivers, for better or worse. But if your goal is to outperform, you need to concentrate more. According to their research, holding around 20 to 25 carefully chosen stocks is the balance point. It's concentrated enough to give you a real shot at generating alpha, but still diversified enough to protect you from the blow-up of a single position. In other words, modern portfolio theory tells us when the benefits of diversification taper off, and intrinsic investing shows us how to use that knowledge in the real world. Start with enough stocks to reduce avoidable risk, but don't over-diversify to the point where you dilute your edge. Now, where does this come from? What is the modern portfolio theory? What diversification really means? And why do most people get it wrong? Modern portfolio theory, or MPT, was introduced in the 1950s by economist Harry Markowitz, and it completely shifted the way the investment world thought about building portfolios. Before MPT, the focus was almost entirely on picking the best individual stocks, the ones with the highest expected return, without much thought about how they work together. Markowitz proved mathematically that it's not just the quality of each investment that matters, but how each one behaves in relation to the others. The key is correlation. Two assets can both be good investments on their own, but if they move in exactly the same way, holding both doesn't really reduce your risk. On the other hand, if they don't move together, or better yet, if one tends to rise when the other falls, putting them in the same portfolio can smooth out the ride. This is why you sometimes see investors holding a mix of stocks and bonds. They don't always move in lockstep, so combining them can give you more consistent returns for the same level of risk. Most people misunderstand diversification because they think it's just about having a lot of different names in a portfolio. They'll buy dozens of stocks without realizing that if they all come from the same sector or are heavily influenced by the same economic forces, they're not actually diversified. You can own 50 tech stocks and still be taking almost the same risk as owning just a handful. True diversification is about owning assets that behave differently, that don't all react the same way to news, interest rates, or market sentiment. This is where MPT's concept of the efficient frontier comes in. It's the curve that shows all the optimal portfolios, the ones that deliver the maximum expected return for each possible level of risk. If your portfolio sits below that curve, you're taking more risk than necessary for the return you're getting. By combining assets in the right proportions, you can move closer to that frontier, getting either the same return with less risk or more return for the same risk. The mistake most beginners make is thinking more stocks always equals more safety. The truth, as we saw earlier, is that the benefits of diversification are front-loaded. The first few uncorrelated assets you add slash your risk dramatically. After a certain point, you're mostly just adding complexity, not real protection. MPT shows us exactly where that point is and why chasing diversification beyond it can actually make it harder to beat the market. Also, in this video, we're only talking about stocks, but ideally, you should have different assets in your portfolio, aiming for 15% to 45% in each asset class. That is 15% to 45% of bonds and safer assets, the same percentage for real estate, the same percentage for international assets, and the same percentage for domestic assets. To simplify, I'm talking only about stocks, but you can apply these same lessons to a diversified portfolio across multiple classes. In other words, you should respect the sweet spot even if your portfolio includes other classes besides stocks. Also, let's face it, it's very difficult to keep track of all this in terms of stocks. If some of those 20 assets in your portfolio are bonds and not stocks, for example, it becomes easier to manage. Now, how does this work in practice? How you can apply this to your portfolio and how to know if you're doing it wrong right now? Well, open Excel in your notebook now. So step 1, list everything you own. In column A, write ticker. In column B, write company fund name. In column C, write sector. In column D, write region. In column E, write weight of portfolio. As you can see, I've already built a dummy spreadsheet here. This part is easy. I don't know if this is as obvious as it sounds, but weight basically means how much you own. Think of your total portfolio as 100%, so Apple takes up 8%, Microsoft 7%, and so on. Step 2, count your holdings. This will tell you exactly how many positions you own. If it's less than 10, you're probably under-diversified. If it's more than 50, you might be over-diversified. Remember, the sweet spot is around 20-30 uncorrelated stocks. Here in my spreadsheet, there are 20 stocks from different sectors. And since each stock has a different weight, it's not just about counting how many times the sector appears. You have to do a trick that I'll teach you. Step 3, check sector exposure. Now, in another part of the sheet, you're building your mini summary table. In column A of this mini table, you've typed each sector only once, no repeats. When you want to know, for example, what percentage of my portfolio is in technology, you use this formula in the next column of your mini table. Ikshal Sumayev, C2, C21, H3, 2E, 21E. Here's what's happening when Excel runs that formula. C2, C21 tells Excel where to look for the thing you're matching, in this case, the sector column from your main table. H3 is the criteria Excel is searching for. It says, only add up rows where the sector equals H3, in this case, technology. E2, E21. This tells Excel which numbers to add up, the weight percent column from your main table. So Excel scans all of column C for the word technology. Every time it finds it, it grabs the matching number from column E and adds it to the total. If you put that formula next to each sector in your mini table, changing H3 to the number in that row, you'll instantly see the total percentage of your portfolio in each sector. And once you've got all those percentages, here's the risk check. If any one of them is over 40%, that means almost half of your portfolio is tied to that single sector, and you're taking more concentration risk than is usually considered safe. Remembering that this also applies to a diversified portfolio across other classes such as bonds, real estate, and international assets, you can create a third table to see if the portfolio is also balanced across sectors using the same formula and logic. That's it, cousins. Stay invested.